Well, I point out about the S&P 500. It looked like a bottom may have been coming together when we finally got back above our 1 week moving average, which we hadn't done since February 20th on a closing basis. That may be out the window today if we get a close below 56.82 right now in the market. And so whatever technical reasoning that I put together for looking for a bottom here and putting on that short put spread at the end of last week would be nullified, and it wouldn't be worth trying to fish until we see a little bit more stability. The momentum could be returning. We do have a FOMC meeting tomorrow, of course, which is something that I know a lot of market participants hang their hat on for a savior. I think you, me, Ilya, we're all in agreement here, which perhaps is a warning sign, but I think we're all in agreement that this is a meeting where the market's not going to get anything that it can hang its hat on. So over the next few days, with expiration, with OPEX, this is a market we're going to see a lot of trading flow. We can't really get married to anything. We have to be willing to abandon any pretenses of a bottom in the short term if this thing starts to get slippery again. This is a very different environment than what we've seen in a few years. We should not be treating this as the simple buy the dip kind of situation as it was in 23 or 24.
Well, I think anytime you get to a sell-off of over 10% or so, you have to, take a little bit different. I mean, we've been bouncing off of every decline pretty much for the last 15 years. So anytime you get a decline where you don't bounce right away, I mean, it is going to be, it's a little different. You're right. And I'm not sure that you can treat it any differently, because I think in the world of trading, there's only a rare situation where you can really treat things differently. But again, there's nothing on my screen that encourages me right now to say, oh, I got to have this. Like, there's no stock that I'm looking at. I think the last 2 days, man, I only remember last Friday and Sunday and then yesterday saying, early this week, I think we're down. I mean, I think we're up, and then I think they could roll over and go retest those lows. And that's kind of what's happening. It's a little earlier than I thought, but
you've had a little bit of everything.
You've had a little bit of everything.
Week.
Yeah.
And, we really haven't gone anywhere. I mean, I think we opened on the E-mini S&Ps at 56.78. You can correct me, Chris, if I'm wrong. On Monday, we're right there. I mean, we're right where we opened. So you've had bulls, you've had bears. We've gone nowhere. We've chopped around.
Yeah, today looks
movement was a little bit larger than I thought.
Today looks exceptionally ugly. It's kind of weird that I'm saying that, but today looks exceptionally ugly. I don't know.
We have to open lower to go higher? 100%. Don't get fooled by Sadnov right now. Stay the course, ladies and gentlemen.
What's interesting about this move to the downside? We've made a correction of at least 10%, right? If the market goes down by 10% but does not go into bear market territory, which is 20% off the highs, we've seen this a number of times since 1950. I would point out that the average 1 month return for the S&P 500 is 3.1%. So, given what we've seen occur already, if the market is going to be finding a bottom, this is about the time that it should be carving out those lows. The average correction we've seen in any given year is about 14.3%. Drawdowns are common, even in the best bull markets. So if we do see a swing to the downside, don't think it's the end of the world. It's actually fairly typical. But this is kind of the time. We are in the window with which the market should start to turn if these are going to be the lows or we're close to the lows.
Well, nothing's turning right now. So far, everything, every bid's been met with a little bit of a sell here. All the Nasdaq stocks that we look at are lower. And when I try to go to the board here to see on the ones that are widely traded, I mean the ones that have the most option trading to them, because that's what we look at. There are few and far in between here. Really nothing. I mean, when you go to Baidu being up $2 and change, that is not the market to me. That's like coming for the pigs. Qualcomm up 60 cents. That's like coming for the pigs, in my eyes.
Yeah, and Baidu is actually Baidu is that stock picked up a little steam last.
Baidu has picked up a little steam. Yes.
But on the downside, they're picking up a lot more steam.
Mm-hmm. Agreed. Yeah, we're right where we opened on Monday.
Yep. So, all right, what else you got, Chris? We're agreeing with you on the market.
So what do you guys take on China here? There's been a discussion point of sorts with the U.S. markets in retreat. The Chinese government seeing this as an opportunity to lure capital back to their shores. They've announced a series of stimulus measures in recent weeks. of course, one could argue if they're actually going to be effective. There's a really great way to distinguish this. Ilya and I were talking about it yesterday. The amount of money going into checking accounts versus what are basically time deposits, certificates of deposit over in China. And people are still taking, like, for every dollar that they're putting in their checking account, they're putting close to $3 into these time deposits, which, if you think about how people spend money, if you're putting money into a CD, that's money you're not planning on touching for 3 months, 6 months, a year. So China right now, they're pumping all this money into the market, but it's not really being spent by consumers. And yet you have these equities that are flying. You also have gold flying. You have silver flying. You have copper flying right now. Do you feel like it's too risky for traders to step in front of this trade, which, I guess, full disclosure, I'm seeing a bubble and maybe something inflating here. And I think the only rational thing to do in that scenario is to ride it. So I'm long all these names.
I mean, we're definitely not short China, that's for sure. So, I mean, if anything, we're like a little bit long. We were really long. Now we're just a little bit long. But I don't think it's as attractive as it was. I'll leave it there. That's what I think. I think China was super attractive, and I think it just got less attractive based on price.
Just because it's rallied so much.
Yeah, just because it's rallied so much.
But his style of trading, he likes to buy the breakout kind of thing. He likes to stay with the momentum trade. I mean, right? Am I right or am I wrong?
I know.
That's what the public does.
Yeah.
That's not necessary. We're talking nice here. There's no need to throw stones.
I mean, that is what the public. That is
yourself. Yes, at yourself.
That is what the public does. I think the public can learn a very good lesson from these Chinese stocks, which is when things get cheap, you just got to kind of hang in there with them, and eventually you'll get paid. And that's the lesson. It doesn't matter. The story will always change eventually, just to, the story will adjust to price. But yeah, the bigger concern for me right now would be that I don't think very many longs have really given this market a lot of, I don't think there's any fear yet out there. So we'll see.
I mean, there should be. A lot of these stocks are cut in half. I mean, you keep mentioning Tesla, but a lot of other stocks are cut in half too or more. So, I mean, you're definitely going to feel it when you look at your 401ks and you look at anything else, because these are all the stocks that everybody's in.
Oh, yeah. Yep. No, I understand that. I'm also just looking, today I'm really looking at vol expansion, because I'm noticing it pretty big time. VIX is up 170, but I'm noticing it big time in all these Nasdaq stocks. With Nasdaq down 330, there's definitely been an emphasis on Nasdaq premium this morning. It's kind of really expanded.
Yep.
Yeah, yesterday, even during the rally, like the sector rotation was just such garbage. It was, XLP is your leadership, XLE is your leadership, OIH, IYE, GDX. The bottom of the barrel was
that should scare the children more than anything else.
Right? Not the leadership group, you want to say.
No, but leadership is something that does change over time, and it needs to, we need to have rotation in leadership in order for this market. If you're a bull and you want another leg up, you got to move off the Nvidias, the Teslas, and it's going to switch to something else. It always does.
I understand that. Last year we went from SMH and the semis in the first half of the year powering the market to the second half. I mean, SMH did nothing from July onwards, and it's actually much cheaper than it was in July of last year right now. But the market was still able to power higher, right? The Mag 7 names are getting really, really hurt. And there's a growing strain of commentary that I'm reading that I certainly believe in myself, that, one of the prevailing factors of U.S. equity market dominance over the past 10 or 15 years, particularly since the global financial crisis, has been this investing mantra known as TINA. There is no alternative to the U.S. You can't invest in a Brexit UK or in deindustrialized Germany or whatever Japan's doing, yada, yada, yada. So you've been forced into U.S. mega cap tech names. It feels like there are alternatives now. Europe offers an alternative. China offers an alternative. And Tom, I know you're going to say, well, how do you trade Europe, right? But the point is, it feels like there are now other options, other doors to go through if you're investing in an incremental dollar. So do you guys see that this pullback in tech stocks is something more foundational, fundamental, long-term that we should be worried about?
That's a good question. Tony? Because I have my own answer.
I don't have a good one. I don't know.
I do think that this is something you should, if that concerns you, yes, this is something you should worry about, because I do believe that the level of saturation and the level of concentration.
Isn't there always saturation concentration though?
Of course, but that usually that's when you have to worry. I mean, but I think this got to an extreme. I think when you look at kind of the top, 20 stocks, I feel like, especially that they were all so tech heavy, I kind of feel it was an extreme. I mean, we've been talking about it on air for 2 or 3 years, so we're not going to change our story now. It's right. I feel like it was an extreme. I feel like they're overinvested in. They're heavy. And I think I think when things get that heavy, they need to get cheap before they get interesting again. And some of these might not be interesting. I think yesterday when Vanetta did a piece saying that Intel's the best performing chip stock, I'm like, really?
Yeah, you're
now you've got serious issues.
Yeah. And Intel hanging in there, only down 4 cents, out enough.
I think there's a lot of passive investors that have a right to be just a little bit nervous that haven't done anything yet. So I do think there is liquidation risk.
Liquidation risk. That's not a fun phrase.
Well, okay. Call it rotation risk. Rotation risk. Like for people that are thinking that, like Tesla's going to go from 225 back to 325, in 2 or 3 ticks now. I don't see it.
Oh, that's over with a long time ago.
That's what I think. Yeah, I mean, for people that think, Nvidia is going to trade 150 again in 3 days, I don't see it. It's not the same market. Could you get a Netflix situation like yesterday where some analyst just comes out of the woodwork? Sure. I don't see it. So,
Netflix down 22, by the way.
Down 24 right now, and it's going to give back, everything from yesterday.